welcome back to Vantage. We've got someone who is new to Vantage joining us today. He runs a balanced portfolio and he's going to explain in a little bit more detail what actually a balanced portfolio is and why over a period of time compounding returns is good for you. Let's go take a look. Welcome back to Vantage. We have someone new on the show and I'm delighted to have Paul Sedgwick from Frank Investments here. Paul, welcome to the show.
Thank you, Neil.
Maybe we can start with just a brief introduction to yourself, Frank Investments, and the fund that you manage.
Okay, so Frank Investments, we've been going for about 12 years now. We describe ourselves as a boutique family office. We have our family's founder was Paul Barry Walsh, an entrepreneur who sold his business about 20 years ago. My background before then was in the city. I worked for several large investment banks, Warburg's, Citigroup, sort of for the bulk of my career. And Paul and I decided that we wanted to combine his knowledge and understanding of the world, if you like, and building businesses, along with my experience working in the capital markets to sort of manage our assets together. And then as time progressed, we've brought in other families with us. We now have about 9 or 10 that we now work with as well. And we run one focus strategy, which is, as you pointed out to, is a balanced equity strategy. But we do have others which we run as well. And in total, we have something over 100 million assets under.
Okay, and let's talk a little bit more about the managed balanced total return portfolio, which is the one that I think you manage. Give me some indication of investment objective, its sort of record effectively in terms of income generation, returns, and roughly the number of holdings and the balance of those holdings.
Sure. Well, so we limit it to a maximum of 30 holdings because we want to ensure that too many holdings and you become too diversified, too few and the concentration risk gets quite high. And we think 30 is about the right number from that. We don't have any one stock has more than 5%, becomes more than 5% of the portfolio, because again we feel that we want to make sure that no one stock becomes too dominant a force in the overall performance of the portfolio. We focus on large cap stocks, so we do diverse a little bit into smaller cap stocks just to sort of give it a little bit of variety, but the bulk of the portfolio is in large cap stocks, and many of them are names that are household names. The idea of the portfolio is to the global economy grows over time. It may shrink from periods of time to time, but it fundamentally grows over a longer period. And I think the aim of our portfolio is to invest in companies that are exposed to the growth in the global economy, so that over a period of time, as the global economy grows, and during periods of recession or weakness, they actually get stronger rather than weaker. And so that where they can take advantage of these periods of time, and that you know that, and we know that the capital that we have within there is going to grow over the longer term. We've compounded about 7% per annum since we started, and we have a balance of income and capital growth.
Okay, and so when you look at the portfolio, how much is in cash, how much is in bonds, how much is in equities? What is that sort of weighting?
Very little at the moment in cash. We have held probably higher amounts of cash than we should have done over the last few years, but as a lot of people have talked about, it's been very difficult to find alternatives to equities because of the lack of returns one's been getting in other asset classes. But actually now that's changed, and it's been great. I mean, the fact that we now can get bonds which at least offer you a yield of some description, gilts yielding you 3 or 4% within 1 or 2 years maturity, is fantastic. And so we've managed to diversify more into the bond market. We've stayed at the shorter end of the curve. But the difficulty at the moment, it also remains for many investors to think about, is real yields are still, particularly in the UK and Europe, are very negative. I mean, you've got inflation running at 9% and you've got interest rates running at 4%. So real yields are very low. So it still forces you to a degree into equities, because if you buy, unless you believe inflation's going to fall very sharply and over the next 10 years it's going to average 2 or 3%, which is what the central banks hope, buying gilts that yield you 4%, you're almost locking in the risk of losing money. So I think this is helping to support the equity, continue to help support the equity market.
So larger allocation effectively going into equities.
Yeah.
And I mean, for the layman, what is the idea of a balanced portfolio? What's the sort of theoretical construct of holding a mixture of bonds and equities and cash in a portfolio?
Well, I think the idea is that what balance between, as you say, bonds and equities, but it's also a balance within sectors as well. So you balance, so you don't want to feel that you're too exposed in one way or the other. And I think that a lot of investment managers, obviously, because that's where the growth was, gets very much caught into the investing heavily into the technology sector, which obviously has done very well over the last few years, but took a big correction because valuations got very stretched last year.
Yeah.
So we try to balance ourselves to have an exposure in all sectors, but not become too overweight in any particular one, so that again it becomes too much of a dominant force within the. But you have to be aware of the changes in economic cycles. You have to be aware of growth sectors versus value sectors. You have to be aware of what point you are in the economy, and what we tend to stay away from is highly cyclical businesses, car stocks which are capital intensive, airline stocks, steel stocks. They do great in economic upturns, but perform very poorly in downturns, and we tend to avoid sectors like that.
Okay. Last year, I mean, there was quite a lot of headlines as we went through this sort of pivot of, suddenly inflation emerging, rates sort of increasing, and then, particularly in the UK, there's sort of all the issues around the mini budget and what happened to the UK bond market around that time. A lot of balanced portfolios struggled, and, from what I read, most of that was attributed to actually, what was theoretically the safe part of the portfolio, the bonds. What did you learn from it, and how did you fare over the last year in terms of your returns through that year?
Thankfully, we survived it pretty well. I mean, we were very, very down, very modestly. We were down our portfolio lost about 1% last year, and as you said, a lot of people struggled. I mean, our portfolio is defensive by nature. Mm-hmm. I think that helped a lot, so we didn't have a lot of highly valued tech stocks in there. Our exposure to the bond market was fairly limited. So there was a high correlation last year as bonds fell. The equity risk premium for very low bond yields allowed higher valuations of equities. Yeah. As those bond yields started to rise, valuations of equities naturally had to fall. Yeah. And that is basically what happened. So a lot of balanced portfolios that were long of bonds and long of equities had the double hit, basically. Yeah. As yields rose, prices fell, and also equity valuations fell. And a lot of the correction last year was the market just readjusting itself to higher bond yields, and less about, which some analysts are still very concerned about, it was less about concerns around earnings and the economic recessions, but more about just a readjustment of valuations of stocks relative to bonds.
Okay. And looking forward, so you've weathered 2022 reasonably well. What's on the horizon for 2023? How are you positioning yourself in terms of an economic outlook?
Well, we try and focus, use this phrase, on the long term, and people always say this, but I think you have to. When you're investing in stock markets, you have to think about the long term. I mean, there are always short-term opportunities that come around, mm-hmm. but in what we do, you focus on the long term. And as I say, our strategy hasn't really changed a great deal. We've taken advantage of some of the weakness in the bond markets to deploy some of the cash that we had. But I think one could make a very good case both ways for equities, on the downside and on the upside. Mm-hmm. UK equities don't look as expensive, or European equities don't look as expensive as US ones still. You've got, as I said, got real yields are still negative, so that's a plus for equities. Yeah. But on the other side, you've got concerns about recessions. You had the Fed chair last night about Powell talking about interest rates have got to go higher. They're pushing, and the real worry is amongst investors, particularly in the US, is that the Fed will push them so high they really will ultimately drive an economic recession. On the other side, you've got employment remains strong, consumer spending has been resilient at the moment. So it's a really complicated picture, I think. But if you focus on investing in companies that have strong fundamentals, that are exposed to the global economy, and you don't force yourself into a position where you're having to sell at the wrong point in the economic cycle, and which is what we try and do, and look at these times as opportunities, which they generally provide. I mean, some stocks have become suddenly become very good value again, and one takes advantage of those.
Okay, and let's touch on that. So we talked about, let's describe the outlook as mixed. And that there are clearly, downward pressures in certain areas, but signs of at least hope and resilience in others. Has there been any kind of rotation in the sectors that you are exposed to, or any kind of themes that are playing through the portfolio?
There's been a genuine shift to value away from growth. What we have done is moved a little bit into the value side and a little bit away from the growth side. But some of you take some of these technology stocks which have come back a long way. I mean, you take, for example, Alphabet, and I know there's a lot of talk around ChatGPT, but I mean, that stock trades on a PE, price to earnings multiple, of around 16 times now. It's got $100 billion on its balance sheet. It's generating large amounts of cash every year. I mean, that's a very defensive position to be in, and stocks have fallen best part of 50%. And so these are opportunities. This is what I'm saying. During these periods of time, you do get these opportunities and to take advantage of.
Interesting. Okay. I always find it useful to get some illustrations to bring a little bit of the theory to life. So maybe you can think about either something that you've added more to in terms of your allocation to, or something new that's sort of come into the sort of portfolio over the sort of last 6-12 months. Is there a name that you sort of suddenly thought, actually, my investment case is stronger now, and I'm sort of prepared to buy into it over the last 12 months?
Yeah, I mean, I think the technology sector itself has provided some great opportunities. You've got the semiconductors, I mean, the world just needs more and more semiconductors. The way the world is going, the demand for semiconductors, I think, is only going to grow. You've seen the demand for, again, copper. A lot of people talk about that, but with this electrification of the world, the demand for copper is only going to increase. And I think these are themes, and you've seen these are opportunities that I think are there. There are some well-known global brand names that are household names, where the spending is pretty much is non-discretionary, and they've come back quite a long way, and I think there's a lot of opportunities there as well. Okay,
so let's maybe add names to that. So how are you playing the chip theme? How are you playing the copper theme? How are you playing the, I guess, value, non-discretionary consumer spend end of things?
Well, I mean, we've looked at Estée Lauder and L'Oréal. We think Estée Lauder, last year it's had a bit of a recovery, but I think that's come back a long way, and that looks much more attractive than it is. As I said, I mentioned Alphabet. I think that is looking an attractive opportunity. I think the semiconductors, Nvidia, you've got Texas Instruments, which offers a 3% yield, so that's quite attractive. I think there's several globals, ASML, which is another, and I think there's some opportunities there. So I think that there's plenty of stocks to. These are the sort of themes and the names that we've looked at and we've added to our portfolio in the last year.
Now, given you've been doing this a long time, I mean, part of the reason we talk to investment professionals is also to, a lot of people watch these videos for their own education, and I guess that particularly for the younger audience, two questions that I wanted to get your views on. Number one, from an advice perspective, how important, if you're starting a career in the city, what's your view in terms of getting a qualification, getting a chartered qualification behind you? How important has that been for you?
Well, because I'm very old. I was grandfathered out of a lot of it, but when I was younger, I did do exams I did, it was the FSA at those days, the FSA accountancy exams, I did the investment analysis and institutional investment advice exam. So I think and a lot of the younger guys do the CFA now, which I think is very important. So absolutely. I think anything that broadens your education, I think that improves your knowledge and gives you something to fall back on, I think is very important. I also think it's the wonderful thing I always think about investment banking and working in the city is the people you get to meet and the different skill sets that you can get exposed to. And so that's an education in itself, and making sure that one learns as much as you can from the vast resources that you have. But when you're starting out a career in the city, I think it's a tremendously exciting place. I always think it's quite funny. The world's always split into people who are optimists and pessimists. But I think if you start a career in the city, you know that over time the stock market will go up. You can be optimistic about the outlook for stocks and for the economy and that sort of thing. But you are going to go through. I mean, I remember 1987 really well when everything seemed. That's the thing about stock markets. As people say, when everything looks great, I mean, everything looked great then. Yeah. And of course, we came in and had a severe shock. Yeah. But it's always unexpected. I mean, nobody predicted 2007. Everybody thought, but everybody ignored the Fed constantly pushing up interest rates, the impact that was having on the economy, and suddenly, and balance sheets and people's ability to pay back debt and everything else. And of course, you had the big crash. And I mean, we had tech of 2000 when you had the big tech bubble blew. But these times give you opportunities as well as pain at the time.
No, so some of my greatest learnings have come through actually seeing businesses through down cycles. Yeah, you learn a lot through that. And intrigued also in terms of, you're running effectively a family office managing wealth. What advice do you give to your children in terms of their future, their savings? What advice do you impart to them?
My advice is to them. I've got my eldest daughter. I mean, my children are in their mid-20s, but I encourage them to invest in the stock market. I think but I encourage them to invest in businesses that they know that they will continue to strive and thrive, irrespective of basically the outlook for the global economy. Yeah. That they are exposed to the growth of the global economy, that they have a brand name that is resilient within the global economy, and to invest in things they understand and know. I mean, I know this is the old Warren Buffett theory, but which is true. I mean, you feel much more confident, I think, owning a company if you understand what it does. I used to say to my children when they were young, I say, look, do you own share? We used to drive past a BP garage. I say, do you know if you own shares in BP, you own a little tiny bit of that garage? And they say, Daddy, why do we want to own a garage? And I go, well, I'm trying to illustrate the point, that they own a little bit of. You forget that as a shareholder. Yeah. You own a little tiny bit of that company. It's really exciting to see how it grows and to see over time the way that investment decisions it makes and understanding how different CEOs and boards develop the company and how different economic cycles impact it. I think it's fascinating. And I mean, I was lucky. My father was a fund manager for many years and then went on to run Schroders. Yeah. So I was brought up with it. Yeah. I grew up with the stock market. My father coming home every evening, talking to me about stocks and shares and what he'd bought and what he'd done and all this sort of thing. And I was lucky that I learnt a lot from him. But it just, from a young age, it gave me a great enthusiasm for it all, and I couldn't wait to get into the city.
It's been a pleasure having you on the show. Thank you so much for coming in.
Neil, it's a pleasure to speak to you.
Thank you.
Thanks.